In this video, we'll reveal 3 stocks that billionaire investors are quietly accumulating before many analysts believe the broader market has a chance to rebound. These are not speculative businesses chasing the latest trend. They are companies with global reach, powerful brands, loyal customers, and long-term catalysts that could drive shareholder returns for years. By the end of this video, you'll understand why some of the world's smartest investors are looking beyond today's market uncertainty and positioning themselves for what could come next. The first stock on our list is Nike, ticker symbol NKE. Few companies in the world have built a brand as powerful as Nike. Think about that for a moment. In almost every country on Earth, millions of people recognize the famous swoosh logo instantly. Professional athletes wear it, college athletes wear it, teenagers wear it, casual consumers wear it. Even people who never play sports buy Nike products. That kind of brand recognition is incredibly difficult to create, and even more importantly, it is incredibly difficult for competitors to take away. When investors analyze businesses, one of the most important concepts is economic moat. A moat is the competitive advantage that protects a company from rivals. Some companies have patents, others have network effects, some dominate through scale. Nike's moat is its brand. The company has spent decades building trust, credibility, and emotional attachment with consumers across multiple generations. When someone walks into a store looking for athletic footwear, they are often not searching for a generic running shoe. They're looking for Nike. That distinction matters, because when a company becomes the default choice in a consumer's mind, it gains pricing power, customer loyalty, and long-term durability that many businesses can only dream about. Yet despite these advantages, Nike stock has spent the last few years disappointing investors. The shares have fallen significantly from previous highs as the company faced a combination of challenges. Consumer spending slowed, tariffs created uncertainty, inventory issues pressured profitability, and perhaps most importantly, management made strategic decisions that weakened relationships with wholesale partners. For years, Nike aggressively pursued a direct-to-consumer strategy. The logic seemed reasonable. Selling directly to consumers allows companies to capture more profit per sale and strengthen customer relationships. But there was a problem. Many Nike customers still preferred purchasing products through traditional retail channels. As Nike reduced emphasis on wholesale partnerships, it created openings for competitors and reduced its visibility in important parts of the marketplace. Investors noticed. Revenue growth slowed. Margins faced pressure, confidence weakened, the stock declined, and that is precisely why some billionaire investors are paying attention today. The best opportunities rarely appear when everything looks perfect. They emerge when great businesses experience temporary problems. Nike remains one of the most recognizable brands on the planet. Its challenges are real, but they are not permanent. Management understands this, and that is where the company's recovery strategy becomes extremely important. Nike has launched what it calls the Win Now plan. This initiative is designed to restore growth, strengthen distribution, improve product innovation, and rebuild relationships throughout the retail ecosystem. One of the most encouraging developments involves wholesale sales. This may sound like a boring operational metric, but investors should pay close attention. Most Nike customers still buy products through wholesale channels rather than directly from Nike stores or websites. If wholesale momentum improves, it signals that the company's products are regaining traction where consumers actually shop. Recent results showed wholesale revenue climbing 5% to approximately $6.5 billion, driven largely by strength in North America, Nike's largest market. That may not sound explosive, but successful turnarounds rarely begin with explosive numbers. They begin with small signs that indicate management's strategy is working, and this is exactly the type of progress long-term investors want to see. Another reason Nike remains attractive is its continued dominance among younger consumers. Many investors focus entirely on quarterly earnings reports and forget an important reality: the future customer base matters. Consumer habits formed during teenage years often persist into adulthood. When young consumers develop loyalty toward a brand, that relationship can generate spending for decades. According to the Fall 2025 Piper Sandler Teen Survey, Nike remained the #1 brand in both footwear and apparel among teenagers. That statistic deserves more attention than it often receives. Teen consumers influence fashion trends. They influence social media culture. They influence purchasing decisions within families. And eventually they become adult consumers with greater spending power. Maintaining leadership among that demographic helps reinforce Nike's long-term competitive advantage. Now let's talk valuation. Because even the greatest company in the world can become a poor investment if purchased at the wrong price. The opposite is also true. A struggling company can become an excellent investment if expectations become too pessimistic. Earlier in the year, Nike traded at more than 40 times forward earnings. Today, that multiple has contracted significantly. The stock trades closer to 29 times forward earnings estimates. Is that dirt cheap? Not necessarily. But valuation is not simply about comparing numbers. It is about comparing price to future potential. If Nike successfully executes its turnaround plan, restores growth, improves wholesale performance, and expands margins over the next several years, today's valuation could look very reasonable in hindsight. Remember, investors are not buying the company's past, they are buying its future, and the future still contains several powerful growth drivers. First, global sports participation continues expanding. Health and fitness remain major priorities for consumers around the world. Running, training, soccer, basketball, and lifestyle athletic wear continue attracting new participants every year. Second, international markets remain important growth opportunities. While North America remains critical, Nike's brand recognition extends across Europe, Asia, Latin America, and many emerging economies. Rising middle-class populations create new consumers who aspire to purchase premium athletic products. Third, innovation remains a core strength. Many investors think of Nike as merely a clothing company. That is a mistake. Nike invests heavily in research, product development, performance materials, and athlete-focused innovation. The company constantly experiments with cushioning technology, manufacturing methods, sustainability initiatives, and performance enhancements. Those innovations help maintain differentiation in an increasingly competitive market. Fourth, digital capabilities continue improving. Although management may have overemphasized direct-to-consumer strategies in previous years, digital commerce remains an important part of the business. The goal is not choosing between wholesale and direct sales. The goal is creating a balanced ecosystem where both channels reinforce each other. That appears to be the direction management is now pursuing. Of course, no investment comes without risks. Investors should remain realistic. Consumer spending can weaken further. Economic slowdowns could reduce discretionary purchases. Competitive pressures remain intense. Tariff uncertainty could affect costs, and turnarounds always take longer than management initially expects. Those risks are real, but investing is ultimately about weighing risks against potential rewards. The market often becomes excessively pessimistic during periods of temporary weakness. That pessimism can create attractive entry points for patient investors willing to think beyond the next quarter. Consider how many times investors have prematurely declared iconic brands finished. History is filled with examples of dominant businesses experiencing difficult periods before recovering stronger than expected. The companies that survive are often those with enduring competitive advantages. Nike possesses one of the strongest competitive advantages in consumer products. Its brand equity spans generations. Its global distribution network reaches virtually every major market. Its relationships with athletes and sports organizations reinforce credibility, and its customer base remains enormous. The stock may not double overnight. In fact, management has openly acknowledged that recovery will take time. But long-term investing rarely rewards impatience. The biggest winners often emerge from situations where sentiment is weak but fundamentals remain intact. That description fits Nike remarkably well today. A globally recognized brand, a loyal customer base, improving wholesale performance, renewed focus on innovation, a comprehensive turnaround strategy, and a valuation that is considerably lower than investors were willing to pay not long ago. For billionaire investors looking beyond short-term headlines and focusing on where a business could be 3 to 5 years from now, Nike represents the type of opportunity that becomes available only when the market temporarily loses confidence. And if management successfully executes its recovery plan, today's skepticism could eventually look like a gift for patient shareholders. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock billionaire investors are buying before a potential market rebound is Carnival Corporation, ticker symbol CCL. At first glance, Carnival may seem like an unusual choice. When investors think about long-term wealth creation, they often gravitate toward technology companies, software businesses, or fast-growing innovators. Cruise lines rarely dominate those conversations, but sometimes the biggest opportunities emerge where investors are least willing to look. And right now, Carnival sits at the center of one of the strongest consumer spending trends in the world, the experience economy. For decades, consumers spent heavily on physical products. People bought larger televisions, bigger homes, more electronics, and countless material possessions. But increasingly, spending habits have shifted toward experiences. People want memories, they want adventures, they want vacations, they want experiences they can share with family and friends. And few businesses are better positioned to benefit from that trend than Carnival. The company operates some of the most recognized cruise brands in the world and serves millions of passengers every year. What makes this business especially interesting from an investment perspective is the scale involved. Cruise lines are not easy businesses to replicate. Building a global fleet requires enormous capital. Operating ships requires specialized expertise. Managing international logistics is incredibly complex. Ports, itineraries, staffing, regulations, marketing, customer service, food supply chains, fuel management, and onboard entertainment all need to work seamlessly together. The barriers to entry are massive. A startup cannot simply decide to become a global cruise operator next year. That reality creates an important competitive advantage for established industry leaders, and Carnival remains one of the largest players in the cruise industry. But if the long-term opportunity is so attractive, why did the stock struggle for so many years? The answer comes down to one word: debt. The pandemic created an unprecedented crisis for the cruise industry. Ships stopped sailing, revenue collapsed, companies had to raise enormous amounts of capital simply to survive. Carnival took on significant debt during that period. Although the company successfully navigated the crisis, investors remained concerned about the financial burden created by those obligations. For years, the investment story centered on a simple question: could Carnival generate enough cash flow to reduce debt while simultaneously restoring profitability? Today, that question is beginning to receive a much more encouraging answer. The recovery has been stronger than many analysts anticipated. Demand remains robust. Booking trends continue showing resilience, and consumers appear willing to prioritize travel spending even amid broader economic uncertainty. That dynamic is particularly important. Many investors assume discretionary spending disappears during uncertain economic periods. Sometimes that happens, but travel has proven surprisingly resilient. After years of restrictions and disruptions, consumers increasingly view vacations as essential experiences rather than optional luxuries. Carnival has been benefiting directly from that behavioral shift. The company recently delivered impressive operating performance, highlighting just how much progress has been made. Customer demand remains strong across multiple brands and itineraries. Occupancy levels have improved substantially, pricing power has strengthened, and onboard spending continues contributing meaningful revenue growth. When cruise demand rises, Carnival benefits in multiple ways simultaneously. Ticket prices improve, ships fill more cabins, guests spend money on dining, excursions, beverages, entertainment, and other onboard experiences. That combination can create powerful operating leverage. Operating leverage is one of the most important concepts investors should understand. When fixed costs remain relatively stable while revenue increases, profits can grow much faster than sales. Cruise lines have substantial fixed expenses. Ships must be maintained, crews must be staffed, infrastructure must be supported. But once occupancy rises and pricing improves, additional revenue often flows through to profitability at an accelerated rate. This is one reason earnings recovery can sometimes surprise investors during industry rebounds, and that appears to be happening with Carnival. The company has generated record customer deposits, providing valuable visibility into future demand. Think about why that matters. When consumers place deposits months before taking a vacation, management gains insight into upcoming booking trends. Large deposit balances suggest customers remain committed to future travel plans. That visibility reduces uncertainty and strengthens confidence in future revenue generation. Another encouraging development involves debt reduction. Remember, debt has been the primary concern hanging over the investment thesis. Management understands this. As operating performance improves, the company has been actively focused on strengthening its balance sheet. Debt reduction creates a powerful positive cycle. Lower debt means lower interest expense. Lower interest expense improves profitability. Higher profitability generates additional cash flow. Additional cash flow supports further debt reduction. Over time, that process can significantly enhance shareholder value. Many investors underestimate how transformative balance sheet improvement can be. A company does not necessarily need explosive revenue growth to create attractive returns. Sometimes improving financial health alone can drive substantial equity appreciation. Carnival's management team appears determined to continue moving in that direction. But the story extends beyond financial engineering. The broader travel market continues offering compelling opportunities. Global tourism remains below its ultimate long-term potential. Emerging markets continue producing millions of new middle-class consumers. Many of these consumers aspire to travel internationally and experience destinations previously unavailable to them. Cruising provides an attractive way to access multiple destinations through a single vacation experience. That appeal transcends geographic boundaries. At the same time, demographic trends support long-term demand. Retirees represent an important customer segment for cruise operators. As populations age across many developed economies, the number of consumers with both available time and discretionary income continues expanding. That creates a favorable backdrop for cruise demand over the coming decades. Meanwhile, younger travelers are increasingly embracing cruising as well. Modern ships offer experiences far different from traditional perceptions of the industry. Enhanced entertainment, upgraded dining options, family-focused amenities, and destination-focused experiences have broadened the customer base considerably. This diversification helps reduce dependence on any single demographic group. Now let's talk about valuation. One reason billionaire investors often outperform is their willingness to invest when narratives remain negative. The broader market frequently focuses on recent problems rather than future possibilities. Carnival is a perfect example. Many investors still associate the company with pandemic-era disruptions and debt concerns. Those concerns were justified, but markets reward future cash flows, not historical headlines. If demand remains strong, profitability continues improving, and debt reduction progresses steadily, the earnings power of the business several years from now could look dramatically different from what many investors currently expect. That possibility creates opportunity. Importantly, Carnival does not need perfection. The company does not need revolutionary technology. It does not need a breakthrough invention. It simply needs to continue executing. Fill ships, maintain pricing discipline, generate cash flow, reduce debt, improve margins, repeat. That straightforward path may not generate flashy headlines, but it can create substantial shareholder value over time. Of course, risks remain. Fuel costs can fluctuate. Economic slowdowns could eventually affect travel demand. Geopolitical instability can impact tourism patterns. Weather events occasionally disrupt operations, and the company still carries meaningful debt relative to pre-pandemic levels. Investors should not ignore these realities. Every investment involves uncertainty. The objective is not eliminating risk. The objective is finding situations where potential rewards justify those risks. That is where Carnival becomes particularly interesting. The market has spent years focusing on what could go wrong. Meanwhile, customer demand continues exceeding expectations. Financial performance continues improving. Cash generation remains strong, and management continues addressing the balance sheet. Those are precisely the kinds of developments billionaire investors often look for. Not perfect businesses, not risk-free opportunities, but companies where perception lags reality, where headlines remain cautious even as fundamentals improve, where today's valuation reflects yesterday's concerns rather than tomorrow's potential. Carnival fits that description remarkably well. If the travel boom persists, if consumers continue prioritizing experiences, and if management maintains its focus on debt reduction and operational excellence, the company could emerge from this period significantly stronger than many investors currently appreciate. That possibility explains why smart money continues paying attention, and it explains why Carnival has earned a place on this list of stocks billionaire investors are buying before the market rebounds. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third stock billionaire investors are buying before a potential market rebound is Nebius Group, ticker symbol NBIS. And out of all three companies in this video, this is the one that could surprise investors the most over the next decade. Not because it has the biggest brand, not because it dominates a consumer category, and not because it generates the largest profits today. The opportunity here is different. Nebius sits at the intersection of one of the most powerful technological shifts in modern history: artificial intelligence. Every few decades, a technological wave emerges that reshapes entire industries. The internet did it. Smartphones did it. Cloud computing did it. Artificial intelligence may ultimately prove even more transformative than all of them. But whenever a new technological revolution begins, investors tend to focus on the obvious winners. The companies making headlines, the businesses everyone talks about, the stocks already dominating financial news coverage. What often gets overlooked are the companies building the infrastructure that makes the revolution possible, and that is where Nebius enters the story. Think about what happens every time an AI model generates an answer, processes an image, analyzes data, or performs a complex task. Massive amounts of computing power are required. Enormous data centers must operate continuously. Sophisticated hardware must be connected through advanced networking systems. Storage infrastructure must handle extraordinary volumes of information. All of this requires specialized cloud infrastructure designed specifically for artificial intelligence workloads. That is exactly the market Nebius is targeting. The company is building AI-focused cloud infrastructure designed to meet the growing demands of businesses developing and deploying artificial intelligence applications. And demand is exploding. Virtually every major industry is exploring AI adoption. Healthcare organizations are experimenting with AI-assisted diagnostics. Financial institutions are implementing AI-driven analytics. Manufacturers are deploying intelligent automation. Retailers are using AI to improve customer experiences. Software developers are embedding AI capabilities into products and services. This trend is still in its early stages. What we are witnessing today may represent only the first chapter of a much larger transformation. And if that proves true, infrastructure providers stand to benefit enormously. Because every new AI application requires computational resources. Every model requires training. Every deployment requires processing capacity. Every innovation requires infrastructure. Nebius is positioning itself to become one of the beneficiaries of that demand. Now, whenever investors evaluate high-growth opportunities, the first thing they should examine is revenue growth. And this is where the story becomes extremely compelling. Recent results showed revenue increasing at an extraordinary pace, with AI cloud revenue becoming the primary growth engine for the business. The company's growth rate has dramatically outpaced what most public companies achieve, reflecting strong demand for its infrastructure offerings. But revenue growth alone does not make an investment attractive. Investors have seen countless examples of companies growing rapidly without creating lasting shareholder value. The more important question is whether that growth reflects a sustainable opportunity. In Nebius's case, there are reasons to believe the opportunity could be substantial. The company is operating in a market where demand continues exceeding available supply. Across the AI ecosystem, organizations are competing aggressively for access to computing resources. Training advanced AI systems requires enormous computational power. Inference workloads continue expanding. Enterprise adoption remains in the early innings, and infrastructure capacity cannot be built overnight. Constructing modern AI data centers requires significant capital investment, specialized expertise, power availability, networking infrastructure, and long development timelines. Those realities create barriers to entry that can benefit established operators. Another reason investors are paying attention is the scale of future demand projections. Many industry analysts expect AI-related infrastructure spending to grow dramatically throughout the remainder of this decade. The reason is simple. Artificial intelligence is becoming embedded into virtually every digital workflow. Search tools, business software, customer support systems, content creation platforms, scientific research, autonomous systems, education technologies. The list continues expanding. As adoption grows, infrastructure requirements grow alongside it. This creates a powerful tailwind for companies positioned to provide the computational backbone supporting the AI economy. One development that attracted significant investor attention recently was Nebius securing a major long-term AI infrastructure agreement that could generate billions of dollars in future revenue commitments. That kind of contract matters for several reasons. First, it validates the company's capabilities. Large customers do not commit substantial resources without performing extensive due diligence. Second, it provides greater visibility into future revenue opportunities. And third, it demonstrates that demand for AI infrastructure remains exceptionally strong. When sophisticated customers commit to long-term agreements, it suggests confidence in the durability of the underlying trend. Now let's address the biggest concern investors should have regarding Nebius: valuation. Unlike Nike and Carnival, which are largely turnaround stories, Nebius is fundamentally a growth story. And growth stories often attract enthusiastic investors. That enthusiasm can sometimes push valuations higher than underlying fundamentals justify. This means investors must approach the opportunity with discipline. The company may have enormous potential, but expectations already reflect significant optimism regarding future growth. Management also expects substantial capital expenditures as it continues expanding infrastructure capacity. Building AI data centers is expensive. Acquiring hardware is expensive. Developing advanced cloud capabilities is expensive. Success requires significant investment. The good news is that these expenditures are directly tied to expanding capacity in a rapidly growing market. The challenge is execution. Management must continue deploying capital efficiently while maintaining growth momentum. That balancing act will be critical. For long-term investors, however, the key question is not what happens next quarter. The key question is what the AI infrastructure landscape looks like 5 or 10 years from now. Imagine a future where artificial intelligence becomes as common as internet access is today. A future where nearly every business relies on AI-powered tools. A future where computational demand continues increasing year after year. In that environment, infrastructure providers could occupy extremely valuable positions within the technology ecosystem. Nebius is attempting to build exactly that type of position. Of course, there are risks. Competition remains intense. Technology evolves rapidly. Capital requirements are significant. Execution must remain strong. And because the company operates in a fast-moving industry, unexpected developments can emerge quickly. Investors should never underestimate those challenges. But they should also recognize the scale of the opportunity. Some of the greatest investment returns in history have come from identifying transformative trends early and owning businesses positioned to benefit from them. Not every company succeeds, not every investment thesis works, but when a company combines strong execution with exposure to a massive secular trend, investors take notice. That is precisely why billionaire investors continue monitoring opportunities throughout the AI infrastructure space. They understand that artificial intelligence is not merely another technology cycle. It has the potential to reshape productivity, business operations, and economic activity on a global scale, and companies providing the infrastructure enabling that transformation could become increasingly important over time. So when we step back and compare all three stocks featured in this video, an interesting picture emerges. Nike offers one of the world's strongest consumer brands, a recovering business, and a potential turnaround story driven by operational improvements and long-term brand power. Carnival provides exposure to the growing experience economy, improving financial performance, strong travel demand, and a balance sheet recovery that could unlock meaningful shareholder value. Nebius delivers exposure to one of the most exciting growth themes in the market, with artificial intelligence infrastructure demand creating opportunities that may extend for many years. Each company addresses a different part of the economy. Each faces unique risks, and each offers a distinct path toward potential long-term returns. That diversity is exactly why billionaire investors often build positions across multiple themes rather than betting everything on a single idea. Some opportunities are driven by recovery, some are driven by consumer trends, some are driven by technological disruption. The strongest portfolios often contain a mix of all three. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd love to hear from you. Which company do you believe has the strongest long-term competitive advantage? Nike's global brand power, Carnival's leadership in the experience economy, or Nebius's position in AI infrastructure? Let us know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.